Okay, welcome back, everybody. Today's Friday. We're still working in Chapter 5, dealing with the other types of governmental funds, dealing with the debt service, permanent fund, and capital projects funds. Um, Wednesday, we went through all the PowerPoints and covered the content that's included in the chapter. Today, what I want to do is just start going through some examples from the book again, just reading some stuff from the book, and just explaining some journal entries, some entries that would be typically seen within these type of funds, just like we did in Chapter 4. What I want to start with today, though, is wrong screen. I want to start with the wrong screen. Um, Here it is. I just want to. This is a little chart here, just as a little review of all the different types of governmental funds. So you can see the top, it starts with the fund name, and then it goes through and tells you some details about the funds. Like it says which ones use the modified accrual basis, which ones recognize current financial resource focus, records encumbrances, records budgets, what the fund description is and what the fund term is. So we're just gonna just go through this just for practice one more time. So first one we see here is the general fund. We know that it operates on modified accrual, as all these do. So the first box can be checked for all of them, but we'll still go through them. General fund operates on modified accrual, so therefore we know it's on the current resource measurement focus, right? Um, it does record budgets and does record encumbrances, and it accounts for all financial resources not required to be reported in another fund. So that's just your main operational fund for your general government. Every government's going to have one. You can't have more than one. They're always a major fund. The fund term is an indefinite life. So as long as the government is up and running, the general fund is going to be as well. So that's the general fund. Special revenue fund, same thing. It operates on both the modified accrual basis and recognizes the current financial resource measurement focus. Um, it also records budgets and encumbrances. It accounts for legally restricted revenue sources other than those restricted for capital projects or debt service. The fund term is for each period that a substantial portion of the resources are provided by one or more restricted or committed revenue sources. So it's just like it says here that the fund term is just for each period. It's just different periods when we shoot that money over there, transfer that money over. And just remember for the special revenue that it has to be restricted or committed. That GASB gave it special attention. The Capital Projects Fund, once again, modified accrual, current financial resource measurement focus. It does not record a budget, and it does record encumbrances within the capital projects. Um, Accounts for financial resources to be used for acquisition or construction of major capital facilities, other than those financed by proprietary or fiduciary funds, because we know those account for it within the relative fund because they're on the accrual basis. The fund term is from the period resources are first provided until the capital facility is complete. So it's basically just for whatever the term of the project is. Next is the debt service fund. It operates on modified accrual, current financial resource measurement focus, and it does not record a budget, and it does not record an encumbrance. Um, so let's see, it's got a little asterisk here next to this one for the modified or the current financial resource measurement focus. It says the debt service funds are required to report only matured interest and principal payments as current liabilities. Unmatured principal installments and accrued interest, though due shortly after year end, are not required to be reported as liabilities in the debt service fund until due. So those are going to be reported in the government wide, right? Not in the debt service, only when due. So that's the difference there of what I want to point out. Debt service, remember, has that breakaway from the modified accrual. It's that exception that the expenditure is incurred when due, not when the liability is incurred. So that's pretty much what it's getting at there. Obviously, it accounts for financial resources to be used for the payment of interest and principal on general long-term debt, and not needed for debt paid for proprietary or fiduciary. They take care of it themselves. From the period funds are first accumulated until the final interest and principal payment is made is going to be the fund term. Lastly is the permanent fund. both modified accrual and current financial resource measurement focus, and it does not record encumbrances or a budget. And it accounts for resources that are legally restricted to the extent earnings but not principal may be used to support government programs. It's got an indefinite life beginning with the initial contribution. So just an important little chart there. It could be really useful to look at this chart. I think this is one of the best charts we've seen, honestly, because it gives you, for all the funds, it tells you exactly what type of activity goes on in it, the term of the fund, and what type of measurements it does. So it's a great little chart here. You can get a lot from it in one-stop shop here. Could be a good chart used for me to pull some questions for a test too. Like maybe I could ask you what the term of the general fund is. Obviously, it's indefinite. Or what the term of a capital projects fund is. It's throughout the duration of a project, something of that sort. Or which ones adhere to the modified accrual basis of accounting, stuff of that sort. So good little chart here. Okay, so next I just want to get into that's not it. Sorry, let me just find out where this. Okay, I got you. Here we go. This should be it. All right. So next we're going to get into an illustrative case of a capital projects fund. Once again, this is pulling directly out of Chapter 5. We're starting on page 120 for those that are interested. I'm going to start out just doing a little bit of reading here, just to give a little overview of the entries we're about to have. So just kind of follow with me. So it says the following case illustrates representative transactions of a capital projects fund. So we're going to assume that early in 2020, the Village Council of the Village of Riverside authorized an issue of $1.2 million of 8% 10-year regular serial tax supported bonds to finance construction of a fire station addition. The total cost of the fire station addition was expected to be $2 million, with $600,000 to be financed by grants from the state government and $200,000 to be transferred from an enterprise fund to the Village of Riverside. The project would utilize land already owned by the village. Completion of the project was expected within the year. Transactions and entries are illustrated next. The 1.2 bond issue, which had received referendum approval by taxpayers, was officially approved by the Village Council. Proceeds of debt issues should be recognized by Capital Projects Fund at the time the debt is actually incurred rather than at the time it is authorized. So we actually recognize that debt when it's incurred, not authorized. So just important there for Capital Projects Fund. Because amortization of an issue does not guarantee its sale. Oh, I'm sorry, authorization of an issue does not guarantee its sale. So just because it's authorized doesn't mean we're going to actually get these. So we have to wait till it actually comes in. The sum of $100,000 was borrowed from the National Bank for engineering and other preliminary costs incurred before bonds could be sold. The notes will be repaid in the current period and are recorded as a liability in the Capital Projects Fund. So obviously we see here, this is where they borrowed $100,000 for the Capital Projects Fund for the engineering and the other preliminary costs. It's recorded here as a liability because it says it's going to be repaid later within that current period, right? So therefore, we're going to record it as a liability in this fund. So we see we borrowed cash, so we're debiting cash. It's an asset. It's going up of $100,000, and we're going to credit the liability of bond anticipation notes payable, right, of $100,000 because that fund's going to repay that. So we don't need to record it in the government line, right? Okay, assume the legislator passes a bill authorizing the grant from the state government. In response to the village council approves the transfer of the enterprise fund. Amounts to be received from other funds within the village government are reported as other financing sources. In contrast, amounts to be received from other governments are reported as intergovernmental revenues, okay? So amount from other governments is intergovernmental revenue, right? The distinction here is that intergovernmental grants increase the overall resources of the village, but transfers within the village do not, right? So if we're just transferring money from, per se, the general fund to the capital projects fund, the resources of that general government or that government are not going up, right? Because we're using the resources within the government. But if it's an intergovernmental grant, and is in this case of the 600,000, then that's going to be revenue. Our resources are going up, right? So let's just look at the actual the journal entry here. We're going to say we have a due from other funds of 200,000, right? Because it says they're going to transfer 200,000 of the what we read earlier. 200,000 is coming from a transfer, right, from within our own government. Then it says due from other governmental units is 600,000 there as another debit, because remember we're having an intergovernmental grant is going to cover another 600,000 of the cost. So then the offsetting credits to these debits would be other financing sources, transfers in of 200,000, right? Because that's just a financing source for that capital projects fund. And it's a transfer in, other financing source, because remember, it's from our own government. Our money's not going up. Our resources are not increasing. But notice here when it's the 600,000 credit, revenues control, intergovernmental revenue, we actually count that as revenue, right? Because it's an intergovernmental grant. So that our resources are going up. So therefore, that's why this is revenue, this is another source, right? So it makes sense, right? We got money coming in from another fund within the government. We counted that as another financing source. And we got money coming in from that's going to be due from other governmental units from the intergovernmental grant, which is revenue. So we count it as revenue. Good on that? Okay, it says total purchase orders for supplies, materials, items of minor equipment, and contracted services required for the project, and they amounted to $247,698. So once again, we order supplies. We have to encumber whatever we order, right? So they said it's for the amount of $247,698. So we can see here we debit encumbrances control for that amount. And then credit budgetary fund balance reserved for encumbrances for the same amount, because now we've encumbered that money, right? Okay, a contract was issued for the major part of the work to be done by a private contractor in the amount of $1.5 million. So remember we said contracts need to be accounted for as encumbrances, right? When we actually go under a contract with another party, it has to be encumbered, just as if we would just order supplies or something like that. So we went into a $1.5 million contract, and we obviously are going to encumber those funds. So we once again debit encumbrances control for 1.5 million, credit budgetary fund balance reserved for encumbrances 1.5 million. Simple enough, right? Okay, next, special engineering and miscellaneous preliminary costs that had not been encumbered were paid in the amount of $97,500. So they weren't encumbered first, right? We just paid this straight up. So we're going to actually incur our expenditure for capital outlay of $97,500, right? And then just credit cash, because we've incurred our expenditure and paid cash. It was never encumbered. So pretty simple there, just paying the cost, right? So when the project was approximately half finished, the contractor submitted billing for a payment of $750,000. Now the following entry converts a commitment, which is the encumbrance. Remember, when we signed that contract in the previous entry for 1.5, we encumbered that fund to show that we had a contract outstanding with the contractor, right? So now what we're going to do is convert the commitment, which was the encumbered funds of the 1.5, into a liability, eligible for payment upon proper authentication. Sorry, I can't talk today. So let's look at this entry. So the first thing I want to do is, like I said, I like unencumbering stuff first, which obviously they've done it backwards here. So I'm going to start with 6B here, because that's just the way I like doing it, so I don't forget to do that. So it's for $750,000 is what he's billed us for, right? So we're going to debit budgetary fund balance reserved for encumbrances for $750,000, credit encumbrances control. So now 750,000 of that has been unencumbered now, right? Of the original 1.5. Next, we have to set up an expenditure, right? Because now we have a liability. He's billed us. He's done the work under the contractual obligation, and he's billed us for it. So now we have to set up the expenditure. So we debit expenditures, capital outlay for $750,000, and credit contracts payable because now we have a liability with the contractor, right? He's done his work. He's billed us. So what's similar to this process here that you see dealing with contracts? It's identical to when the government does what? Order supplies. When the supplies come in, we have to reverse the encumbrance and set up the expenditure because the liabilities do, right? Same thing, contracts. When we go into a contract, we encumber the full contract amount. As bills come in from the contractor, we unencumber the funds and we set up a liability or pay them, right? Which makes sense because it's when expenditures are recognized when the liability is incurred, right? Okay, it says the transfer of 200,000 was received from the enterprise fund, and 300,000 was received from the state government. I'm sorry. So obviously we're receiving money, so we're going to debit cash of $500,000. Due from other funds, we credited $200,000 because remember the enterprise fund was going to send us some money. They were going to transfer some money. And then the due from other governmental units of $300,000, which is part of that intergovernmental grant of $600,000 we mentioned in the beginning. So easy. We've just received some money here, debit cash, and then credit the due froms, right? Because we had the due froms set up as an asset earlier, so we have to reduce that asset. Okay, it says the bonds were issued at a premium of $12,000 on January 2nd, right? As is generally the case, the premium must be used for debt service and is not available for use by the Capital Projects Fund. Remember we said at any time the cases, remember we were talking about sources of money for the debt service fund, and it says it usually transfers in from the general fund, but it could also be from premiums, accrued interest, and residual equity within the Capital Projects Fund, which would be transferred to the debt service. So this is what we're getting into as an example of when we could see a premium on a bond, okay? So we know the premium was $12,000, right? So entry 8A records the receipt by the Capital Projects Fund of the proceeds of the bonds, okay? So let's look at 8A here. So we know the bond was for $1.2 million, right? But we know we also had a $12,000 premium. So it's going to be 1 million or 1.212 million, right? 1,200,000. So we're receiving that amount of money. So we're going to debit cash at that amount. Then we're going to credit other financing sources, proceeds of bonds for the 1.2 million, and then credit other financing sources, premium on bonds for 12,000, right? So we're just telling where the sources of money came from, right? 12,000 of it was a premium. On it was just straight from the proceeds of the bond, the face value. So now it says 8B records the transfer of the premium amount to the debt service fund. So obviously now we're just going to debit other financing uses, transfers out of $12,000 because we're transferring it out, and then credit cash of $12,000. So we've issued the bonds, right? We've received the cash, including the premium. We've put the proceeds where they belong with the proceeds of the bond and the proceeds of the bond premium, and then we debited other financing uses, transfers out, credit cash because we're putting it to where?
Debt service.
Debt service because it's a premium, right? And we need to put that where the debt is. Okay, so it says if bonds were sold at a discount, either the difference would be made up by a transfer from another fund or the capital projects would have fewer resources available for the project. Okay, so generally bond issue costs would be involved and would be recorded as an expenditure. So we know a lot of times, I'm just looking at the opposite end here, opposite perspective of what we just seen. Last we've seen a premium, that's how we deal with it, right? It's going to be transferred to the debt service fund because it's more than what we actually needed for the bond proceeds. In the other case, like I said, if it's for a discount, there's going to be a shortfall of cash within that fund. So either the general fund can make up for it with the transfer, or there'll just be a shortage of cash on the project, stuff of that sort, right? So it's either going to be short or another fund will make up for it in the case of a discount. Um, and then it also says here that bond issue costs. We know that bond issue costs, or in our for-profit sector, we know we have to have bond issue costs when we issue it, right? And when we account for it in that, it's just a reduction in the amount received for the bonds, right? That's how we account for it in the for-profit sector. Well, in this, it says we account for it as an expenditure. So bond issue costs, just think of it as like interest on a short-term note payable. Remember how the interest is counted as an expenditure, but not the principal? So just think of the same thing for bond issue costs. It's just going to be an expenditure. So if bonds were sold between interest dates, the government would collect from the purchaser the amount of interest accrued at the date of the sale. So meaning a bond is usually sold at January 1, year one, right? And it's sold and it has interest payments on June 30th and then on December 31st. So if we sell that bond to a purchaser on March 30th, then we're going to charge them the price of the bond plus the accrued interest for those first 3 months, right? Because whenever he receives that interest payment on June 30th, it's going to be for 6 months of interest. So he'll just be getting that money right back. But in order for us to pay him that interest, he has to pay it up front. So that's what that's saying. So if the government issues it in between interest payments, then they're going to collect that money of the accrued interest, right? And then remit that interest because they get the full interest payment. Same as in for-profit practice if a bond is issued between payment dates. Let's see here. Okay, so if bonds are sold between interest dates, the government would collect from the purchaser the amount of the interest accrued to the date of the sale because a full 6 months of interest would be paid on the next interest payment date. Interest payments are made from the debt service funds, therefore cash in the amount of accrued interest, so at the time of bond issue costs should be recorded in the debt service fund. So it says the Village of Riverside's Capital Projects Fund pays the bond anticipation notes and interest, which interest in this amount is assumed to be $2,500, and records the following entries. So remember at the beginning we needed to borrow $100,000 with this anticipation note right here, the bond anticipation note. We needed it for the engineers and some preliminary work done before we actually started the project. Well, now it's saying we're repaying this bond. And we've seen this entry before in an earlier lesson. We're just going to debit the bond anticipation notes payable for the face value of $100,000. And then if you notice here, once again, remember interest is counted as an expenditure, right? Because it's actually using some of our funds, right? Whereas before the bond that we received, the proceeds, it wasn't ours to begin with. So we're just debiting the original credit. But interest has to be an expenditure. Then obviously cash of $102,500 is sent out for both the face value and the interest. Simple enough, right? Main thing here is just know when it's a short-term note payable, paid from within the fund, incur an expenditure on interest. That's the main thing here. Okay, the contractor's initial claim is paid. Remember, he claimed he billed him $750,000, and it's less of 5% retention. So we paid him the $750,000 less of 5% retention. So retention of a contractually stipulated percentage from payments to a contractor is common until the construction is completed and has been inspected for conformity with specifications and plans. So meaning, if we're under contract, say me and you, we're in a government, right? And we've contracted out to a certain contractor, and he billed us that $750,000. So what we're going to do when we pay him that money, we're going to keep a 5% retainer because we're not going to totally trust him and saying, hey, he's going to finish his work because it's not totally finished yet. We're going to wait till it's finished, and we're going to wait till we inspect what he did to make sure he did what he said he's going to do, right? So that's normal within dealing with contracts. You see that in your for-profit, you see it in your governmental sector. So this is nothing new here. So let's just say here, so contracts payable. So we're going to pay him, right? He billed us, so now we're going to relieve that liability. Contracts payable of $750,000. We're going to pay him the cash of $712,500, and then Credit contracts payable, retained percentage of 37,500. That's that 5% retainer, right? So upon final acceptance of the project, the retained percentage will be paid. In the event that the government finds it necessary to spend money correcting deficiencies in the contractor's performance, the payment is charged to contracts payable retained percentage. So if he either just leaves, packs up his stuff, leaves, and hits out of town and just doesn't finish the work, or if he cut corners and it wasn't up to specs, and we can't get the building up to code or something because he did these shortcuts, then we're going to actually pay that money out of the retainer we sent them. We're not going to incur an expenditure. We're going to debit that retained percentage that we originally had set aside, right? So disbursements for items ordered at an estimated cost of $217,000 amounted to $216,500. So of that original entry that we recorded in entry 3, that we did that we encumbered $247,698 for materials earlier on. So what they're saying of that is, of that order, $217,000 of that expected order was received. So obviously we need to unencumber $217,000. So we debit the budgetary fund balance reserved for encumbrances and credit encumbrances control for $217,000. And then obviously we debit the expenditures capital outlay of $216,500 because that's the actual cost, and then credit cash, right? So same thing here, just repetition, right? It's nice how these funds, once you kind of get one fund, they kind of operate the same way, just in different purposes, and some have different rules. So you can kind of see that these entries are kind of repetitive, aren't they? So assume the contractor completes construction of the fire station and bills the village for the balance on the contract. So he's completed it. So now, once again, I'm going to skip around and do what I like to do first. I like that encumber them. So the remainder of the encumbered funds for the contract payable was $750,000. So we're going to obviously unencumber those with the debit the budgetary fund balance reserved for encumbrances of $750, and credit encumbrances control for $750. And now we're going to debit expenditures capital outlay $750 and credit contracts payable for $750, right? Because now we've incurred the liability. Okay, assume the amount due from the state government was received. So they still owed us $300,000, right? So we're just going to debit cash, credit due from other government units, $300,000. Simple, right? Not bad. So invoices for goods and services previously encumbered in the amount of $30,698 were received and approved for payment in the amount of $30,500. Additional construction expenditures not encumbered amounted $116,500, and the entire amount was paid in cash. So of this, let's go ahead and reverse that. The stuff that we had encumbered with the debit to budgetary fund balance reserved for encumbrances of $30,698, credit encumbrances control for $30,698. Because remember, it said that invoices for goods and services previously encumbered and in the amount of $30,698 were received. And remember, $30,500 was what we were approved for payment. On top of that, $116,500 was not encumbered for additional construction expenditures. So that's where we're seeing the difference with the expenditures capital outlay of $147 and cash for $147, because it's the actual amount of $30,500 and the $116,500 that we see with the $147. But we had to unencumber what was previously ordered, right? So they're just kind of combining entries right here instead of doing them separate. You were good on that one? Okay, now assume that inspection revealed only minor problems in the contractor's performance. And upon correction of these, the contractor's bill and the amount previously retained were paid. So now what we're going to do is debit contracts payable, retained percentage of the $37,500, right? Because he's fulfilled all of his obligations now, everything's good.
Debit contracts payable of $750,000 because remember we unencumbered them and we incurred that liability for the second half. So now we're getting rid of that liability and we're just paying the contractor the full amount that we owe them left of $787,500. Makes sense, right? Not bad. Um, So after entry 15 is recorded, 36,500 in cash remained in the capital projects fund. That amount was transferred to a debt service fund for the payment of bonds. So now obviously debit other financing uses transfer out because we're transferring the money over to the debt service fund, credit cash. So once again, remember residual equity, we said that's one of the stipulations of money being transferred from the capital projects to debt service. So we're moving it out there because the projects, it was finished, right? But that was the residual equity, so we've moved it. Okay, upon completion of the project and disposition of any remaining cash, the following closing entry was made. So remember, we still have closing entries on this, but the only difference is it's when the project is completed, right? And it's done after we've already moved the residual equity. So what the entry is going to be a debit to revenues control of intergovernmental revenues, because remember, these are closing entries, so it's going to be the opposite of what we did throughout the operational account. So revenues control, intergovernmental revenues, we debit it for 600,000. Remember that was part of the money that was being used to fund it was from the intergovernmental grant. Other financing sources transfers in of 200,000 from the enterprise fund. Other financing sources, proceeds of bond. Remember it was for 1.2 million. Other financing sources. Remember we had the premium on the bond of 12,000. Credit expenditures, capital outlay. Throughout all the stuff we just went through, we did a total of expenditures of 1.963,500. Other financing uses, transfers out of 48,500, and that includes your premiums, your residual equity, and the other money that was transferred out. So that's the closing entry. Not bad, right? Not bad. So main thing with the capital projects fund, um, what type of accounting does it operate under?
Projects that are modified accrual
Right.
basis.
Right. Does the capital projects fund recognize encumbrance accounting?
No. Yes.
Yes. Right. Because remember, GASB specifically says contractual obligations should be accounted for with encumbrances and committed, right? So they should be committed to. So yes, capital projects fund does encumber funds because we're dealing with contracts and ordering supplies and stuff like that. So it does. What is the term of the capital projects fund? What is the life of the term of it?
The term of the project.
Term of the project, right? And how does the capital projects fund receive money? Get the funds in that fund? What are the main sources that they get it?
The governmental fund, bonds.
Bonds, yep. And it's special assessments on taxes, stuff of that sort. So anything of that, it could be donations, anything of that sort. Let's see here. What's the three situations when we would have to transfer money from the capital projects fund to a debt service fund? What are the three things that would trigger that?
Premium on bonds.
Yep. That's something that accrues.
Interest.
And accrued interest, yep. And what else? Think about when we were doing that project, we had something that was left over. Remember the residual equity? We moved that. If there's money left over after the project. So if it's the premium on the bond, the accrued interest, or the residual equity, we put that in there. And besides that, other transfers are going to just come from the general fund. Just another thing, just remember when we do follow through encumbrance accounting for contracts, it's the same as it is for just encumbering funds when we order supplies. You know, we encumber it when we actually sign the contract, or same as when we order supplies. When they fulfill part of their contract, they bill us. We unencumber it, set up the liability, and then ultimately pay them. Right? What do we do? What's something we do when we deal with contract accounting? when we're getting when we're getting when we're actually making payments to the contractor. What's one thing we're going to do to make sure they fulfill what their obligations are?
We're gonna retain.
We're gonna hold a retainer, usually about 5% retainer, to make sure. If he doesn't fulfill, the contractor doesn't fulfill what he's supposed to do, where are we get what account are we going to debit
That,
that retainer, right? Because we're not going to incur an expenditure. Okay, so I think we're pretty solid on capital projects funds. Let me see here. I want to see what all. I don't want to get too far ahead. I might start a little bit. Actually, you know what? It's Friday. And we've been covering ground good. We've only got about 13 minutes left. Let's go ahead and just call this a day. We'll go ahead and just call it a day, quick today. Then on Monday we'll pick up and we'll go over the debt service fund, some illustrative examples on that. There's not too many issues or examples in that. And same with the permanent fund. There's not too many examples there. So Monday we'll stop here with capital projects. Monday we'll go over the debt service and permanent funds, and we'll also just review a little bit. We'll end it with reviewing over the governmental fund financial statements that relate to the entries we made for these three funds, right? So we'll go through that. So that's all I have for today. Remember, Connect assignments are due for chapter 4 are due this week, right? Chapter 5 will be next week. So chapter 4 will be due this week. Make sure to get those in. Due at 11:59 p.m. Sunday. We're still working in chapter 5, and like I said, we'll wrap up chapter 5 on Monday. Any questions on anything we've covered so far? Makes sense? It's pretty verbatim, right? You just got to get used to, the main thing is getting used to them transfers, ends, and the terminology really is what's different. And just getting used to seeing that encumbrance. I think you're pretty sound on encumbrances now. It's pretty simple, right? You encumber them, you unencumber them. So anything sticking out of that seems more difficult to you than other topics? Or does it seem like everything's kind of flowing pretty well?
everything's going pretty well. I'd say the hardest thing on the homework is just getting the statements right. But besides that,
Like building the statements, like within the activities that they're having you go through. Yeah, well, I say that's probably the hardest part of it. But when you're building the statements, just remember your journal entries. Journal entries are so critical to attention to detail, because those journal entries is what's doing the placements on the statements. So really, if you get like the trial balance and stuff, if you can get the trial balance, like, you should be able to do the actual statements, because it's pretty much, you know what I mean, the trial balance in the closing process, you're pretty much right there, because once it's closed, that's what it is, you know what I mean. We'll go through some examples. Like I said, Monday we'll look at those statements and try to relate to how they relate to the entries and stuff, and help showing you how they build. Are you having more trouble with a particular statement, or just in general, both of them?
just in general.
Just in general. Okay, yeah. Well, we'll touch on that some more on Monday. Just for a heads up on exams, I'm not really big on having people build statements. I might ask questions regarding it, because my perception is, if a student understands that, you make your entries and you have your trial balance, and if they know the closing process, then you can build the statements, because like I said, the hard work's done from that point. You're just splatting it on the canvas pretty much, you know what I mean? And in all reality, in practice, once you get out of school, you're not going to be sitting down with a piece of pits on a paper and building those anyways. It's all built within the software. You're going to make journal entries in the GL, and that GL is going to build it for you. It's going to populate them as is. So as you make your debits and credits, your financials are going to be adjusted in real time. So that's why I'm so critical on journal entries in the closing process, because if you can do that, you're going to be fine in industry. You know what I mean? So but it's still like that's just the way we really make sure you get it, by dissecting them. So we'll touch on it, but don't let that like beat you up. Don't beat yourself up over it, because that is a difficult process. But just know that you're not alone, and I still even have issues with it from time to time. So just know that, and also know in practice, you're not going to have to worry about actually building them and stuff like that. The only statement you actually have to build is like a statement of cash flows, stuff of that sort. Certain other statements, but your balance sheet and income statement builds itself as you do journal entries. So yeah, we'll spend a little bit of extra time focusing on some financials and stuff to make sure it relates how the correlation between the entries and that. So I appreciate you telling me that. Hopefully everything else is going well. Any other questions or concerns? You good? All right. Well, I appreciate everyone's time and effort with everything. And just remember to get those Connect assignments in for Chapter 4 on Sunday. And we will wrap up Chapter 5 on Monday. I hope everyone has a good day and a good weekend.